All right. What's up, guys? Hope you're doing well. James here from jamesdforsythe.com. And I wanted to go over a recent blog post from the Fed's website, basically going on about oil and gas production, right? Going on more of the economic side. They kind of cite the the Dallas Fed survey that they did for the oil and gas industry, probably, I think it was Q1 of 2022 or maybe 2021. I don't remember off the top of my head, but we'll get to it in a second. So with that being said, we'll just switch over to the screen share. Okay. All right. So oil and gas production boomed during the years leading up to the pandemic. From 2011 to 2019, oil production more than doubled and dry natural gas production rose by more than a half. So remarkably, these gains occurred despite lackluster investment spending and hiring. Instead, higher production came largely from productivity gains via wider adoption in fracking technologies, which we'll get into more in a second with actual graphs and things like that, right? So basically, it seems like it's the shale oil boom in a way, right? So basically, there's innovative new technology in a way that basically was adopted for fracking, and then that it increased productivity so much, right? Even though I believe there was actually even a decrease in the amount of labor costs in a way, which we'll get into in a second. So basically, according to the economists analysis, that the slower productivity growth and investors' demands for higher returns made the U.S. firms willing to boost output only at a higher threshold oil price, right? Which we'll also get into at the very end of the post, right? On why this may be changing and so on, right? So basically, the real net output in the oil gas extraction industry more than doubled in 2011 to 2019, that whole past decade. And then, according to the data published by the BLS, a development shown as the top line in the chart, in this chart, which is this red one right here. As you can see, this is an index where 2011 is equals 100, one of those. They love indices. So basically, just showing it more than doubling. One about 200, or one about went about to 200, right? And then you have this other thing called multi-factor productivity, which we'll get into in a second. And then these are the actual real inputs, is the gold line. So you can see that if real output doubled, but the real inputs only increased by, say, 10, maybe 20%, right? So relatively, that's huge, right? So the chart also shows a measure that the BLS for real inputs rose only modestly over the period, what I was just saying with the gold line. So instead, the boom was driven largely by productivity gains, by the efficiency with which capital, labor, and intermediate inputs were used rather than their quantity, which again, you can see by the fact that the real output, the red line, basically follows, or I don't know if follows, it correlates with the light blue line, the multi-factor productivity, what they were talking about, because there's multiple factors that can go into increasing productivity, right? And so that's why it more closely follows the productivity line rather than inputs, kind of showing that this was due to the increase in productivity. Excuse me. So this conclusion can be quantified via the economic concept of multi-factor productivity, MFP, a measure of the portion of output growth not explained by combined growth in inputs. The intuition is that increases in MFP reflect technological and organizational changes that boost output for a given quantity of inputs, right? So it seems like it's more of changing the system in general, whether through the technology that's used or the organization of it itself. Um, so that's in there. So more detailed data show that input growth came largely from increased use of intermediates, energy, materials, and purchased services. Capital inputs rose by only about 5% over the period, with investment spending mostly going to offset depreciation. Labor inputs actually declined, reflecting a drop in hours worked, right? And so the amount of labor necessary for this actually decreased, right? And so it is just kind of emphasizing the fact that this was through productivity and actually like creating a more efficient system in a way, right? So the oil and gas productivity boom owed to the adoption of refinement and of fracking and related technologies. These technologies enabled producers to access oil and gas embedded in shale and other tight rock formations to achieve remarkable gains in drilling efficiency. So indeed, data from the U.S. Energy Information Agency, seen in the chart below, show crude oil production per active well more than doubling from 2011 to 2019, right? And then gas was about 50%, right? So total wells in operation, meanwhile, were basically flat. Basically, it seems like you have this dashed light blue line is the gas, and then this black line is the oil, and this is per well. So the amount of barrels per day went from, we'll say, 14 for oil per well to about 26 or so, because this is on the left axis, right? And then on the right is for natural gas. And so you can tell with 2011, it's kind of at the bottom of both of these curves, where the natural gas version was probably about like 120 or so, and then went up to we'll say 190 ish, right? And so that's still a very significant increase. Um, and the actual difference between the oil being double, right, and the natural gas being only 50%, even though they're visually like the same, it's because of the scaling on the axes, right? Just wanted to point that out in case it's kind of visually confusing or could be for some people, or if you're not looking at that specifically. So their estimate of economic profits, shown by the blue bars in the chart below, see if I can get both of them on the same screen, declined over the period with persistent losses setting in after 2014. And so this is where kind of the title of the video comes in, to where even though there was so much more, the oil and gas industry was so much more productive, there was still not, it didn't really translate into an increase in profits overall. And why was that? And we'll kind of get into that in the next few sections, right? And so you see the blue bars are the oil and gas profits, which they estimate. And I believe this is it the EIA or the BLS that does it? I'm not sure who does it. Anyway, the sources is from the BEA, so the Bureau of Economic Analysis, and then the U.S. Energy Information Agency is probably where you get the oil prices and such, right? Or well, that's the oil prices refer to WTI, and yeah, so there's those, and you can tell that so the estimated profits. The one thing I really noticed when looking at this chart was the fact that the zero line for oil and gas profits is at about $65 per barrel, right? So anytime oil was below that, below $65, they basically estimated negative profit, right? So the industry losing money. And whenever it was above it, they thought it would be gaining it, right? So that's kind of their, I guess, neutral price. And we'll see later, according to that Dallas Fed survey for the oil and gas industry, that the industry itself disagrees with the $65 per barrel, right? As kind of a neutral price, or at least in terms of growth, we'll say, right? And so they kind of give this to, or I guess explain this kind of disconnect in a way between the productivity we saw during the decade and then the profits that we saw in the decade, which is shown by the right half of this chart. Because 2011 is right about here, if you guys can see my mouse, about dead center on the chart. And so you can tell that they had, we'll say, kind of an average or so around 40 billion US dollars in profit was estimated for the industry during the first few years. And then at about 2015, when the price of oil started to tank, or well, I guess, I don't know if I'd say tank, but like it went below that $65 a barrel. Basically, they estimated like massive losses in the industry to the tune of almost double of what they had as gains in the previous kind of 5 years. What I mean by that is, where before in like 2011 to 2015 or so, they were estimating around 40 billion in profits, to whereas in the afterwards in like 2015, 2016, and it looks like we're going to kind of exclude 2020 for now for obvious reasons. Um, basically it was like negative 70 to negative 80 billion, right, in losses rather than gains. So basically, what productivity growth gave, lower prices took away. And so a comparison of 2019 with the situation in 2009 is also instructive. So oil prices were about the same in both years, yet profits were lower in 2019 with higher input costs, putting a lid on the industry's financial performance despite remarkable productivity gains, right? And so still input costs are always a major factor, right? And so we're getting to the point to where my highlight tool kind of started to fail and stop working. So we're going to pretty much wing it for the rest of it and kind of go over the gist. So U.S. production and investment were slow to recover in spite of the bounce back in prices, talking about the beginning of 2020 and the pandemic and all of that. And so crude oil production in June of 2022 was about 7% below its level in early 2020. Gas production was only barely above that level, right? And real capital expenditure in the second quarter for oil and gas extraction was down some 15% from that pace, right? And so they kind of give this into three important factors, so to speak, for or what they attribute this kind of slow bounce back, we'll say, in the actual kind of investment into the industry. And they give this with uncertainty, investor pressure, and slower MFP gains. MFP, again, is multi-factor productivity, right? And so uncertainty, they talk about how there were multiple, they say, plausible scenarios under which oil prices might fall. And so that basically disincentivizes the actual companies and stuff to invest in it, because if they're uncertain about what the future holds, it's one thing I think a lot of people don't realize about, especially like oil refineries and that kind of thing, is like these aren't just small investments. Like you can't just like flip on a switch and it works. You have to like it takes years to build these things. Like if you've ever seen them, they're massive ordeals that have a lot of moving parts, and they're not that. I don't know if I'd say they're not simple, but they're not. They take a while to build, right? It's a very large investment, and so if they're going to have to basically invest that much into building a new refinery or um, maintaining old ones, they're not really going to. The future's gonna play a major role in that, right? And that's just kind of, I guess, a general concept in a way. But also, investor pressure was another factor. And so I misspoke earlier. It was 2022 was the Dallas Fed Energy Survey that we're citing, right? Not 2021. And so basically, when asking the firms what factors were holding back their production, the most common answer was investor pressure, basically to maintain higher returns. And so apparently 60% of the surveyed firms said that was a major factor, right? And so basically they'd already been burned twice, and the investors have been burned twice. And so they kind of just want that return instead of basically throwing more money into this sort of thing just to have prices tank again, so to speak, right? And then the last one, slower MFP gains. And so firms may be responding to worries that the industry is nearing the end of outsized productivity gains. And so basically, this kind of factor has slowed significantly to where it, as in like the beginning of the 2010s and the very beginning of this booming period that we've been talking about, it was nearly 10%, whereas now it's gone down to 2.3%, it seems, right here. Like I said, my highlight tool isn't working. And so the slowdown likely reflects the maturing and now near universal adoption of fracking technologies, right? So unless there's more innovation and investment, we're kind of, it seems like at a cruising altitude in a way, I guess would be a good way to say it, right? And so kind of as a last thing that I'll say is, according to the same Dallas Fed survey, they were asking like what prices would oil need to be for firms to have that form of investment, right? To be in growth mode, as they say, right? And so it said 41% of firms said $80 to $100 a barrel. And then another 29% cited a price above $100 to $120 a barrel, right? And then the rest of them, so I'd say the 70%. So 30% of them um, said the decision did not depend on prices, right? Of whether or not they would basically invest more. And it's one of those, it seems like a lot of that could have to do with like ESG. Cause I mean, like, why would you, as an oil company, like, why would you invest so much money and time and expertise into something that you're told is just basically going to be killed in 20 years, 20, 30 years, whatever it is? And so, still, it's something to keep in mind. Um, it's one of those, it's not a simple transition, so to speak. There's a lot that goes into it. Um, yeah. And this is kind of in the backdrop of this whole past decade that the Department of Energy estimates that 75% of the increase in global production of liquid fuels in general, so not just oil and gas, came from higher US production, right? So there's that as well. So it's one of those, keeping in mind, and we're done with the screen share. So I guess my biggest takeaway from this post in general, is that there was a major disconnect between the productivity and the profits for the oil and gas industry, and there's multiple factors that go into that. And it's just something to keep in mind because there's a lot of nuances when you have to deal with stuff like this, especially with such a fundamental industry to the global economy and that sort of thing, right? Is that you really have to keep this stuff in mind. Um, and just in general. So it seems like we were saved by innovation once, and we'll see if we can do it again. But yeah, anyways, I'm going to leave it there. So I hope you guys have a good night, and I will see you on the next one.